There is a paradox in algorithmic trading that all experienced creators of automated strategies are well aware of. On the one hand, we have access to almost unlimited data, sophisticated machine learning tools, and advanced software such as StrategyQuant X. On the other hand, most strategies that perform well in backtests collapse in the real market. The reason is usually insufficient system robustness. That is, its ability to maintain performance even when market conditions change. This is where the Six Sigma methodology, originally developed in industry but also extremely suitable for the systematic construction of trading strategies, can help. The Six Sigma principle and its transfer to trading. Six Sigma was developed in the 1980s at Motorola as a tool for reducing errors and improving production quality. At its core is data-driven process management, performance measurement, and the identification of sources of variability. The basic philosophy of Six Sigma is that any process, whether it's manufacturing microprocessors or building business strategies, can be improved if it is measured, analyzed, and systematically optimized. In the traditional Six Sigma DMAIC cycle, define, measure, analyze, improve, control, goals are defined. The current state is measured, the causes of problems are analyzed, improvements are implemented, and finally the entire process is stabilized. In trading, this framework can be used to move from intuitive strategy creation to quantitative management of the process of building, testing, and deploying strategies. Defining the problem. Define. What do we actually want to optimize? In the first phase, we must clearly define what we want to achieve. Most beginners in StrategyQuant X blindly chase the maximum profit factor or the highest Sharpe ratio. Six Sigma teaches us that we must first precisely define the defect, that is, what we consider to be a failure of the strategy. For example, a loss of more than 20% from the account maximum, too large a drawdown, or low consistency of monthly results. The goal is not to create a strategy with the highest profit, but a process that reliably produces strategies within acceptable statistical limits. In other words, instead of searching for the Holy Grail, we create a system that behaves stably. Measurement. Business strategy quality metrics. In industrial Six Sigma, the number of defects per million units is monitored. In trading, we can similarly quantify strategy quality using metrics such as profit factor, R-squared performance curve, Monte Carlo stability, or robustness index. In StrategyQuant X, for example, we can stipulate that the strategy building process should produce at least 95% of strategies that remain profitable after applying Monte Carlo simulation. If this percentage drops, we know that undesirable variability has entered the system, similar to manufacturing. With this approach, strategies are no longer evaluated in isolation. Instead, we begin to measure the quality of the entire data mining process, which is a fundamental prerequisite for robust trading. Analysis. Searching for sources of variability. In this phase, Six Sigma searches for the causes of process inconsistency. In trading, this could be excessive optimization, too narrow a selection of markets, poorly chosen data granularity, or inappropriate filters. For example, if we find that strategies with a lower timeframe than M30 show lower stability after deployment, this may mean that excessive market noise is entering the process. StrategyQuant X allows for a very detailed analysis of the results of the construction, from the distribution of parameters to the correlation between metrics. Using this data, we can pinpoint where the process is failing. For example, we may discover that most good strategies are based solely on a specific combination of filters, which indicates high data dependency and therefore low robustness. Improvement. Optimizing the strategy development process. Once the sources of variability have been identified, the optimization phase begins. This does not involve optimizing individual strategies, but rather optimizing the process of developing them. In practice, this may mean 1. Introducing rules for minimum dispersion of results between the out-of-sample and in-sample parts. 2. Expanding the database to include different market regimes. 3. Using statistical selection of strategies based on robustness quantiles. 3. Reducing the number of variable parameters in the genetic algorithm. These steps reduce the likelihood that the results were generated randomly. This makes the process more stable, which is exactly what we want to achieve in the spirit of Six Sigma. Control. Keeping the process under supervision in classic Six Sigma. The process is constantly monitored after improvement to prevent errors from recurring. In trading, this means regularly checking the performance of strategies after deployment and evaluating their stability. StrategyQuant X offers tools such as walk-forward analysis, live monitoring, and portfolio stability visualization. These tools allow you to monitor whether the strategy metrics remain within acceptable limits. For example, if the Sharpe ratio or R-squared deteriorates beyond a predetermined interval, the system issues a warning, similar to when a machine exceeds its tolerance limit on a production line. This approach allows you to manage the entire strategy lifecycle over the long term, from idea to development, testing, deployment, and maintenance. Statistical process control in StrategyQuant X. One of the key benefits of Six Sigma is the use of statistical tools to manage variability. In trading, this can mean using control charts to track metrics across generations of strategies. For example, we can record the average robustness index from each building campaign in Builder and evaluate whether the process remains within control limits. If the average shifts outside the tolerance, we know that the process has lost quality, perhaps market dynamics, data, or parameters have changed. In this way, the strategy building process becomes a controlled system rather than a chaotic search for random results. Six Sigma and the data mining trap. One of the biggest problems in strategy creation is data mining bias. A situation where, out of a million randomly generated strategies, a few are selected that happen to work in backtesting. Six Sigma views this problem as a process error, too much variability without control. The solution is to introduce measurable control points instead of blindly testing millions of combinations. For example, each step of the process, from generation to robustness testing, should have clearly defined output tolerances. If 90% of strategies fail the Monte Carlo test, it is a signal that the construction process itself is poor, not that we need to generate another million strategies. Practical implementation in StrategyQuant X. In practice, Six Sigma can be applied at several levels. 1. Setting goals. We define which metrics will represent a quality strategy. 2. Data collection. We export results from Builder and analyze the distribution of key metrics. 3. Variability analysis. We monitor how the quality of strategies changes with different settings. 4. Process improvement. We adjust generation parameters, filters, and selection conditions. 5. Stability control. We regularly monitor outputs and intervene only in case of deviations. In this way, strategy building is transformed from an experimental activity into a controlled process with measurable quality. Conclusion. Six Sigma brings to algorithmic trading what most traders lack: discipline, measurability, and control over the strategy creation process. Instead of trying to find the ideal strategy, it leads to the creation of a process that systematically produces high-quality, robust, and statistically stable strategies. StrategyQuant X, with its data mining approach, is the ideal platform for this methodology. Thanks to its tools for robustness testing, metric analysis, and statistical evaluation, it allows Six Sigma principles to be implemented at every stage of development. The result is not only a better strategy, but also a stable development system that can survive market volatility in the long term. And that is ultimately the true meaning of robustness: the ability to withstand change even when the world around you is changing.